G'day. How do banks make money? Originally, banks offered interest rates on deposits and then applied higher interest rates to borrowers, and the profits between them were made between the margins. The banks had their own assets and cash securities to lend to others. The tools of trade for the banks is money that was formerly backed by gold bullion. Banks had a safety deposit boxes as well for valuable items, and fees were charged for their use. Banks used a multiplier effect to increase the amount of money they could lend on deposited funds. Essentially, they would bet on the fact that most depositors would not want their money back quickly. We all, possibly, remember Mary Poppins and the fiduciary bank. One of the interesting things that I've discovered this week, on the 9th of April, in the Business Insider, there was a run on the Australian banks. Cash withdrawals happened from the Australian banks to the tune, by some people, of hundreds of thousands of dollars, whereas there were others who withdrew millions of dollars. This is a very fascinating thing. This shows the uncertainty of the times that we're in at this moment. And they are very uncertain times. Banks were secure, or are secure, in the knowledge that house prices will most probably always increase. So it makes their mortgages more secure as the days go on, helping to secure their house mortgage portfolios. However, we have to recognise that mistakes have been made in regard to this, particularly when second and third mortgages were involved. We know full well what happened in the global financial crisis. Essentially, that was about a failure of the housing market in the United States and what they did with those mortgages and the other borrowings that the banks held. They were overexposed and unable to manage the whole thing because they rely upon the selling of a house which is where there's been a mortgage default. But if it can't sell, the bank can't recover money. Central banks were established in every country just for the purpose of controlling and managing the economy and directing monetary policy, which is essential to how the whole economic flavour of the economy continues. In Australia, the central bank is called the Reserve Bank of Australia, and it is there to set and direct the economy via interest rates and cash supply. The bank sets the interest rates which they lend to other banks. They print cash or withdraw cash. Usually when they're printing cash, that tends to become inflation. In other words, it will cause the inflation rate to increase. The other essential role of the Reserve Bank of Australia is to be the banker for the Commonwealth Government of Australia, and that's an essential role. In recent years, the banks have moved their tentacles into all areas of commerce, to the extent that banks, via their asset management plans, are involved in a significant areas of the economy, in all significant areas of the economy in fact. And hence, they have a huge impact upon all areas of government. With the inquiry into financial services institution, the reason why there was no prosecution is more than likely related to the fact of the close connection between government and the financial industries. No one is prepared to honestly answer those questions. I know that the government did not recommend prosecution, and yet the penalties associated with this is 10 years imprisonment, $10,000 fine for each and every occasion of conspiracy to defraud. We know that that's what they did, and we know that no one was charged. There have been some very recent developments which are important and significant. With this coronavirus, we have found there's a lot of things happening with the economy. To try and manage the spread of this disease, the government has essentially shut down the economy. Both unemployment and underemployment are now at unprecedented levels. Business activity is at a total snail pace, with many businesses closed. Government-backed payments to compensate for the shutdown are being promised at unprecedented levels. A stimulus package to the tune of billions of dollars that will not take effect until after the economy is restarted, when the government is satisfied that the coronavirus is in fact under control and fully contained. Interest rates are at an extremely low level, at 0.5%, that is 0.05%. And the threat of negative interest rates is looming large before us. Parliament approving a ban on cash transactions of over $10,000. Even though this has not been approved or been assented by the Governor-General, which is the process of making a bill that's passed through the Parliament to become law, it is there. Had it have been approved, the run on the bank could not have occurred, because it would have been illegal to withdraw the tens of thousands and hundreds of thousands and millions of dollars that were withdrawn. We're moving into a new theory which has been developed. It's called the Modern Monetary Theory, MMT. This has been developed, and it has moved the increasing money supply to a new level. Money supply usually is only a small amount of the total money supply that is going to be extended. But we are now looking at a level of potentially $200 billion. When you increase the money supply, what that's called is called quantitative easing. However, normal quantitative easing, as I've mentioned before, only is a small increase of the money supply into the economy, and it does tend to be somewhat inflationary, and so lots of other levers have to be pulled to prevent the inflationary aspect, but it does help to stimulate the economy. How the injection of this almost $2 billion into the economy has not been made public by the government. But I would hasten to add that I believe the injection of these funds will be with a percentage of cash, and the rest will be electronic. And so we can refer to the cash as being physical currency and the electronic currency being virtual currency. Any huge injection, as I've already said, is in injection of money into an economy is very inflationary. And when it's as massive as this one would expect it to be. But because the interest rates are virtually at zero, and if the inflation rate remains over 1.5% and yet below or at 3%, we could find that the debt created by this $2 billion cash injection will be able to be paid back in about 45 years without one single payment being made. You'll see a graph there that explains it to you. This is a very unusual place to be. We've never been there before. Ever since we've left the gold standard, which is what happened originally, you had currency was issued based on the gold standard, and the value of your currency was related to how much gold bullion that you actually kept. But nowadays we have forgotten that, we've cast that aside completely, and now we have what's called floating currencies. And our currency is weighted against other currencies during the currency trading and to determine its value. Hence, that's why you see this movement up and down of the value of our currency against other currencies. And you'll note, if you look at that over time, you'll see there's a variation between how it works against one currency and another, because each one of those currencies also are floating, except for, I believe, the Chinese do not float their currency. The problem that we have is, will this direction, this new direction we're going, will that, this modern monetary theory, will that actually create some unintended consequences that we don't know? It's completely unknown. It's a place that no one has walked. But the other problem is, if governments can create currency out of thin air, just, we want to have some more money, and so put some more figures into the equation, the question we've got to ask is, what will happen under the circumstances of an oppressive government? The other issue is, how will this affect the exchange rates because of our floating exchange rates? How is it going to affect them and therefore our imports and our exports? How is that going to happen? One of the things that we can be safe about is that we are not acting alone with this modern monetary theory. Others are doing the same thing or similar things to overcome the stimulus which they plan to drive through their economies to get them kick-started again after shutdowns. But all of these things will come with consequences. The consequences of the direction we're going. And how should that affect our policy development is the essential area where we, as a political party, must go. To actually have this whole theory work, this whole process that's happening, we need a lot of trust in the financial institutions, and they have demonstrated that they don't deserve that. Because we're in uncharted waters with this modern monetary theory, the problem we actually have to make sure that we can see that our financial institutions do the right thing. Currently, we can't be so sure of that. So consideration to policies that will prevent such breaches from happening must be seriously considered. And these are a few suggestions. Distancing the government from private financial institutions. Creating enforceable processes and regulations for all financial institutions to adhere to. Limiting the control that any private bank has in the economy, perhaps by limiting monopoly control in all areas of policy. Re-establishing a government-owned bank, government-owned, government-controlled bank, so as to set the standard as formerly the Commonwealth Bank did. Preventing a cashless society and a dual currency economy being established, which could have differential regulations concerning virtual cash and actual cash from the economy. The problem we have is the International Monetary Fund is in fact making many recommendations. There are many papers on establishing a different treatment of electronic cash or virtual cash and actual cash. They also have programs about and advisements on how to withdraw cash from society. These are a few areas which I consider we need to look at very closely, very seriously, and see what we can do to prevent that. We need to stop the international ownership of financial institutions. The policies to slow down globalization of financial products and also other industries, and to bring some back, to actually, if we can use the word, to de-globalize our economy, would be an appropriate thing to do. During this particular crisis, the Prime Minister has made a number of announcements about a number of things. And as I conclude this part, before I talk about some things about billionaires, what I think it's important to note is the few words in the Weekend Australian of the 11th of April 2020. Under this particular arrangements that the Prime Minister has suggested people to go along, his company directors have been given license to steal from shareholders through discounted share issues. Directors have also been given a license to steal from creditors while trading insolvently. And super fund members have been invited to steal from their own future by taking money out of their super funds. Remember, that super fund is designed for your retirement. To remove it beforehand is to steal from your future funds. The big question is about banks, and this is something important, I think, is in which bank do you believe that billionaires would store their money? Well, actually, it's the wrong question. We're under the wrong assumptions. Billionaires do not store large amounts of money in banks. That's why they're billionaires. They do not have that much cash, actually. Becoming a billionaire does not mean having billions in cash. It means having a net worth of 1 billion or more, and in most cases this net worth is based upon the valuation of a company they own. So the money is in the company. But even the company does not really have the money, as the valuation of the company is based upon its assets. And only a small portion of these assets are actually cash money. The reason why they are billionaires is that they do not store their money in banks, as this is the least profitable thing to do. The way a bank makes money is taking the money you've stored there and using it for investments. So there are only two reasons for having large amounts of money stored in banks. Either you are highly risk averse or you do not know how to invest your money in a profitable way. Both cases are rather unlikely what road to become a billionaire. However, even billionaires have some money in the bank to cover living expenses. These banks probably meet the following criteria, and hence maybe we should think about this too. They are located in a developed country. Billionaires look for a low risk of getting into any situation where the bank is not able to provide a customer access to the money. So putting the money on a bank of a politically unstable country would not be a good idea. They offer high interest rates. Now, as a billionaire coming with lots of money, they are in a good position to negotiate an interest rate on invested capital far above what any other person would have. So hence they get the premium amounts. The more money you have to put into the bank, the more you are capable of suggesting a better interest rate for your situation. They also have big connections. Hence, those connections do make a big difference. Most of us, when we go to a bank, we are nothing but a number. But billionaires, those movers and shakers of the economy, they are people. Because the bank needs their money for the multiplier effect. The multiplier effect, I will just simply reiterate what that is. Simple. If you have $10,000 and you invest it in a bank, the bank can lend at least $9,000 of that. And when it lends a $9,000 of that, its asset base has increased. The $10,000 that you have, the $9,000 that the loan value is. And so that makes it up to $19,000. And therefore they can again lend against that $19,000. And as they lend against that $19,000, they can do it again and again and again. That's called the multiplier effect. So one $10,000 deposit could, depending upon how risky the circumstances are and how risk averse the bank is, it could go a long way to creating a huge amount of money in the bank's economy. Having said that, if you came back to the bank to withdraw your $10,000 and the bank couldn't supply it, there would be a problem. But most depositors can't withdraw money to that magnitude without giving notice. Obviously, if you are a billionaire, you can withdraw your money because you will give more notice, you will have a connection, a relationship, and you'll be able to do far better. Thank you. I hope this is helpful to you. Thank you.